Welcome. Today, we're diving into one of the most important financial documents out there, the income statement. We're going to break it down step by step so you can really understand the story it's telling.
Okay, so let's jump right in. The best way to get a feel for the income statement is to put it side by side with the balance sheet. A balance sheet, you see, is like a photograph. It's just one single snapshot of a company's finances at a specific moment. But the income statement? That's the movie. It shows you all the action over a whole period, like a quarter or an entire year, telling you the story of how the company performed over time.
So this financial movie is tracking the total change in a company's value over that period. And accountants have a special name for this whole story. With all its twists and turns, they call it comprehensive income. Comprehensive income is really the big picture number. It captures the entire change in a company's net assets. You know, what it owns minus what it owes, from pretty much everything except for money coming directly from owners or being paid out to them. So that includes all the revenues, all the expenses, gains, and losses. It gives us the full, complete story.
Now, every good movie has a main plot, right? Well, for a business, the main plot is its core operations, the very reason it exists. And that's exactly where the income statement kicks things off, right at the top.
The story opens with revenues. That's all the money the company earned from its sales. Then, right away, we subtract the direct cost of making those goods or providing those services, and that gives us our first key figure, gross profit. Okay, so from that gross profit, we then subtract all the other costs of just running the business. Things like marketing, R&D, administrative salaries, we call those operating expenses. And what's left is another super important number, operating income.
So why is this number so crucial? Well, think of it this way. Operating income tells you exactly how profitable the company's main business is, all by itself. A healthy, growing operating income is a great sign. It cuts through all the other financial noise to answer one simple question. Is the day-to-day business actually making money?
But you know, the main plot isn't always the whole story. Companies usually have other financial subplots going on. We're talking about things like earning interest from investments, or, on the flip side, paying interest on debt. These aren't part of the core business, but they definitely affect the final bottom line. So, starting with our operating income, we now factor in these subplots. We add or subtract those non-operating items, and then, of course, we account for taxes. This brings us down to another really key figure, income from continuing operations. Now, this is a fantastic way to see the difference. Operating income is pure. It's just about the core business. But income from continuing operations gives you a wider view. This distinction is so helpful because it lets you see how much of the profit is coming from the sustainable, day-to-day operations versus those other, maybe less predictable financial activities.
And sometimes, a company's story takes a huge dramatic turn. We're talking about a major plot twist, like when it decides to sell off a massive part of its business, maybe an entire product line, or it exits a country completely. This is what we call a discontinued operation. And just to be clear, we're not talking about selling an old building or some used equipment here. A discontinued operation is a fundamental, strategic shift in where the company's headed. It's a significant part of the business that can be clearly separated from the rest of the company.
And this is exactly why it gets its own special section. By separating out the results of the part that's being sold, it gives investors a much, much clearer picture of what the ongoing business, the company of the future, is going to look like. It just helps everyone make better predictions.
And you know, companies can't just slap this label on whatever they want. There are very strict rules. They have to meet all of these criteria. Management has to be totally committed. The part of the business has to be ready for immediate sale. They have to be actively looking for a buyer. This makes sure it's a real, definite plan, not just some idea they're kicking around.
Okay, so let's bring it all home. We take our income from continuing operations, and then we factor in that big plot twist. We add or subtract the results from that discontinued part of the business. And that finally brings us to the grand finale, net income. You know, the famous bottom line of our financial movie. So, we've watched the whole movie, from the opening scenes all the way to the final number. Now it's time for the critics' review. What did we actually learn? And just as important, what are the limitations of this story? Make no mistake, the income statement is an incredibly powerful tool. It lets you evaluate how a company has performed in the past, which gives you a solid foundation for trying to predict its future. You can stack it up against competitors, and it helps you get a sense of the risk or certainty of the company's ability to generate cash down the line.
But, and this is a big but, it's not a perfect crystal ball. Net income is really an estimate. It's built on a whole series of assumptions and judgments by management. And it's also important to remember, it doesn't even include everything.
That big picture comprehensive income we mentioned at the start, it actually includes some other gains and losses that don't even make it into the final net income number. So both numbers together tell an important story.
But now you get the structure. You know how to read the story from the core operations to the subplots to that final bottom line. You've basically unlocked the ability to read the financial story of any public company out there. So the only real question is, what financial movie are you going to watch first?